In an op-ed this week in the Wall Street Journal, oil expert Dan Yergin says that while the market seems calm, despite the Israel-Hamas war, nothing guarantees that this will last. Dan joins us right now. He is the vice chairman of S&P Global and also the author of the new map, Energy, Climate, and the Clash of the Nations. And Dan, we saw oil prices drop almost 5% yesterday. That's a bit surprising given the backdrop. What makes you think this won't last? What's the next thing you're watching for?
There are three things at work. I mean, Becky, if you look at it now, oil is literally about $9 lower than it was the day before Hamas invaded Israel, which tells you there's no geopolitical premium, fear premium in the price at all. And three factors are at work. Number one is supply, is the incredible growth of non-OPEC plus oil led by the United States, which is today producing more oil than any country has ever produced in history. And there's Brazil and Canada in that list. The second reason for it is that the markets are focused on the economy and worried about the economy. And thirdly, the oil exporters are, the Arab oil exporters are not interested in using oil as a weapon. They're interested in economic development. So those are the factors there. And as long as the war doesn't spread, the market is focused on these economic factors.
How does OPEC react to that?
Well, I think OPEC has a problem. It's going to meet the weekend after Thanksgiving, and it's looking at prices below the level that they want to do. They've already cut. Will they cut more, or will they just sort of say, let's get through the first quarter of weakness and see where we are in the second part of the year? But this is these prices are not what they intended.
I guess the demand picture is the biggest wild card in all of this, slowing demand from China and other places around the globe. And while the economy is still very strong here, we're not seeing the same inflationary push that we'd seen before.
Well, I think that's right. And, the China reopening was a big factor. Oil demand up 2 million barrels a day this year. But China's only going to reopen once. It's not going to reopen again. So demand next year will be more tempered. And you're going to have this continual buildup of supply that really wasn't anticipated a year ago by many people.
But you get back to the point where you say this calm might not last. Is that your base case scenario, or is that an outlier or potential of something that could happen?
Well, I'm not thinking it's interesting. I'm not thinking of it in terms of base case. It's just probabilities. There have been something like 50 barrages by Iranian-linked militias on U.S. forces in Syria and Iraq since October 17th. And so the question is, will there be some assault, some barrage on oil infrastructure in the Persian Gulf? Because that's the key thing, because 21 million barrels a day of oil pass through the Strait of Hormuz. And the country that has the most to worry about is a country whose leader has been visiting the United States this week, Xi Jinping, because China imports half of its oil through the Strait of Hormuz and imports virtually all of the Iranian oil that now comes through the Strait of Hormuz.
That's interesting. I hadn't put that connection together. You think that's part of the reason that Xi Jinping is
Well, I think that, that they have problems in their economy, which was demonstrated by that outreach to all the CEOs in San Francisco. And so to have an oil spike, a disruption, is not something that the Chinese economy needs. It's benefiting from U.S. sanctions on Russia, Iran, and Venezuela, because right now it's getting cheaper oil.
Dan, your call, again, back to probabilities, if you don't want to call it base case, fine. If you get back to probabilities, what would you say at the beginning of the next year? Where do you think things will stand January 1st?
Well, I think January 1st, will be still probably in a weak period, because that's when demand goes down. We still see over the year at this point, I would say that we still see oil averaging next year in the kind of the mid 80s. But, with all these uncertainties, because, who predicted on October 6th where the world would be on October 7th?
Oh, that's true. Again, though, people are looking to try and figure out what the next question is. Is supply just going to be the overwhelming issue with all of this? The idea that the United States can now produce so much that that's going to take us out of some of those higher risk factors?
Well, it's the United States combined with Brazil, Canada, and Guyana, which is the new factor in the market. And at this point, we do see that production continue to increase. We don't see the U.S. increasing by 1 million barrels a day next year, which it did this year, but maybe 400,000 or 500,000 barrels a day. But that is what's, if you go to basically supply demand, That's the key factors. This growth of non-OPEC plus oil being greater than the increase in